Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 76, titled Five Top Myths and Misunderstandings About Covered Call Writing. Over the years, I've had the good fortune to speak with thousands of covered call writers from all over the world. And one common thread, speaking with these investors, is that there were certain things they learned from the BCI methodology that they were under a terrific misconception about. And it kind of made investing with covered call writing more palatable. So what I did was I put together for this particular podcast the top five of these myths, and we're going to debunk them one by one. So let's get started now. The first one is that covered call writing should be used in flat market conditions only. Now, that's just simply not true, because once we master the three required skills, stock selection, option selection, and position management, that will allow us to craft this strategy so that we can succeed in all market conditions. And we accomplish this by selecting the most appropriate stocks and exchange traded funds for bull markets, which would be securities that have a bit more implied volatility, not crazy implied volatility, but a little bit more than we would use in a bear market environment. Also, the type of options that we select. In a bull market environment, or even in normal to bull market environments, we can favor out-of-the-money call strikes. This will give us the opportunity to generate two income streams with each trade, one from share appreciation from current market value up to the strike price that's out of the money, and the other from option premium. So two potential income streams when we're using out of the money strikes in normal to bull market environments. Now, in a bear market or a volatile market environment, we want to have more protection, so we would lean to the in the money strike, which has a time value and an intrinsic value component to it, which will bring us our break even down lower than at the money and out of the money strikes. Also, the type of exit strategies that we use when we're managing these positions will be a little bit different in bull and bear market environments. So the thought that the covered call writing strategy can only be used in flat or neutral markets can be taken right to the nearest incinerator and dumped down there. All right, let's move on to the next myth. We should focus in on stocks and options that generate the highest returns. Okay, well, here's the truth. Option premium is directly related to the implied volatility of the stock or the exchange traded fund. There's no disputing that. However, what's going to attract an investor to covered call writing? The answer is the fact that it's a low risk strategy, and capital preservation is very important. So why should we then select a high implied volatility stock, which would then convert this strategy to a risky one? Why don't we just simply pick a different strategy if our personal risk tolerance is very high? So instead, what we do is we don't even have to look up the implied volatility stats. All we have to do is select an initial time value return goal range. For me, it's 2 to 4%. That will align with our personal risk tolerance and strategy return goals. So by sticking to that 2 to 4% for my approach to covered call writing, will tell me that the implied volatility is not through the roof or something that would be inappropriate for me. Now, in a very strong bull market, I might go as high as 6% for 1 month near the money strikes, but never higher. But generally speaking, in normal market conditions, my sweet spot for initial time value return goals is 2 to 4%. Now, in my mom's more conservative portfolio, I set a goal of 1 to 2%. One size doesn't fit all. Only you know what the appropriate range is for you. Okay, let's look at myth number 3. 90% of all options expire worthless. That I hear over and over and over again. It's simply wrong. The truth is 10% of options are exercised. So what happens to the other 90% of it? Do they expire worthless? The answer is no. And what happens is 55% of them will get closed. So if someone buys an option, they'll then sell it and close that option position. Doesn't expire worthless. So 55% are closed. That leaves 35%, not 90%, that will expire worthless. Those of you who are watching this podcast, this graphic explains precisely what happens with our options. Myth number 4, we're forced to sell winners and retain losers. Well, that almost implies like we have no control of our covered call writing positions. That also is simply not true. The truth is, when we sell a covered call, we're accepting an obligation to sell our stock at the strike price by the expiration date. That is true. However, that obligation can be canceled by buying back the short call option. That's part of our exit strategy arsenal. And mastering that skill set will leave us in control. Let's not make the assumption that once we enter a covered call trade that we're totally hopeless, okay? Because we can take action to craft the results of our trades to meet what's going on during the course of that contract. Same holds true for underlying stocks. So we're not forced to retain those stocks. We can close our short call if that stock is significantly underperforming the S&P 500 and sell it. We have total control of that situation. So as we manage our positions, our portfolio ultimately will consist of elite performers because we're managing our trades during the contract. And it will generate initial time value premiums that align with our conservative goals. As I said earlier, 2 to 4% in my case. Now, that doesn't mean the end of the contract month I end up with 2 to 4%. Could be more, could be less. But that's my starting point. And myth number 5, and the final one that we'll be highlighting in this podcast, sell options prior to an earnings report to generate the highest return. Wow, that one is definitely wrong. We should never, ever sell an option prior to an earnings release. Once again, earnings reports can be favorable or disappointing. We know the date of the earnings report. It's a risky time. Why don't we just avoid the risk? We make plenty of money selling options in a conservative way without representing an earnings report as part of our strategy. So why take on that risk, as I said before, with covered call writing, which is a very conservative strategy for, I think, applies mostly to retail investors, although we do have a lot of professionals that do follow the BCI methodology. But what if we have a stock that we really like? We have a lot of confidence in. Really, it's a long-term holding as far as we're concerned. Okay, fine. Hold the stock through the earnings report and then write the covered call after the report passes. Yeah, so why should we take a conservative strategy and turn it into a risky one? The answer is we should not. And what we're looking to do with covered call writing is not to make a mint on a trade, but to have modest, consistent returns that will allow us to beat the stock market on a consistent basis. Risk is to be avoided, not embraced. Okay, well, let's just summarize now. A critical part of our financial education is to debunk a lot of these long-standing myths that are very pervasive in our society. You know, one person says it, the next person says it, and after a while it becomes what's considered a truth, when the reality of the situation is it's just simply not the case. Now, if you master the 3 required skills that we talk about all the time in the BCI methodology, stock selection, option selection, position management, we will be able to unmask these truths of covered call writing and create opportunities to achieve the highest possible returns and beat the market on a consistent basis. And we won't depend on risky applications of covered call writing to accomplish these goals. Okay, ladies and gentlemen, before we go, I just want to remind everybody about the tremendous number of free resources located on the www.thebluecollarinvestor.com website. Particular interest to you would be the free resources link on the top black bar. You may also want to have a look at our free beginners corner tutorials, one on covered call writing, one on selling cash secured puts. Our books, DVDs, trade planners, calculators, online mentoring programs, all can be found in the store link on all the pages of the bluecollarinvestor.com. We have tremendous wealth of educational products that will allow us to master the strategies of covered call writing and selling cash secured puts. Folks, I want to thank you so much for taking the time to listen to and or watch BCI podcast number 76, 5 Top Myths and Misunderstandings about covered call writing. Folks, I hope you enjoyed this presentation, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.